Welcome back to Store University Lesson 7. What's the best way to finance your corporate real estate? I'm Chris Volk, CEO of Store Capital. In our prior videos, we've taken a look at how to compute the impact of your real estate financing alternatives over the first year of their implementation. And in the case of the model we established for this lesson, leasing is better than owning, at least for the first year. But what happens after that? Well, this gets a little bit interesting. In our financial model illustration, we assume that annual revenues increase 2%, but the lease only increases an average rate of 1.5%. It is not uncommon for rents to grow at a slower pace than inflation, which means that your equity rates of return in future years may be expected to increase. You see, equity rates of return aren't static. They change all the time based upon the changes to the 6 V formula variables. Conversely, with the election to own real estate, your loan amortization will alter your mix of YAM and interest-bearing OPM. As you pay down a loan, what you're really doing is actually reducing the percent of the company that it's financed and increasing the amount of the company that's funded with YAM. This is what is meant when one talks about building up equity in real estate. Your balance of capital sources is shifting. With these changes in mind, let's see what happens in year 5 to equity rates of return in our illustration. Here it turns out that the leasing current pre-tax rate of return rises from 85% in year 1 to over 93% in year 5, which is a function of stable operating margins and a lease rate that rises slightly slower than sales growth. But for the ownership illustration, the rate of equity return actually falls from 37.9% to just below 35%. This is a function of the YAM percentage rising to about 48.3% from the starting point of 39.1%, which offsets the benefits of elevated profitability arising from revenue growth. The illustration I have made here shows that it's not really enough just to look at year 1 and know which type of real estate financing appears better. You really have to look over many years. At the same time, I'm not really one for using a multi-year model, looking at the equity cash flow differences and discounting them back at some interest rate to arrive at a present value difference. First of all, the equity rate of return you stand to realize every year stands on its own and will change all the time. Since equity rates of return do change from year to year, there's not always some single number. Second, it's virtually impossible to envision exactly what's going to happen every year. There's a great deal of optionality in your behavior at any given time. So it would be wrong to draw out our model over 20 years because you'll likely refinance the property and thereby alter your capital structure and equity returns at the time. And thirdly, you don't know what you would do with your excess cash. The basic model just looks at the capital stacks in a vacuum. It's simple. But what if you were able to take your excess cash that resulted from higher lease proceeds OPM, and then take the YAM you saved from leasing and plow it into business growth? In such a case, not only would you benefit from greater stock appreciation arising from superior capitalization, but you would also stand to gain even greater wealth and returns from an increased opportunity to expand your business with the YAM you saved that did not have to be dedicated to real estate. I demonstrated this for you at the end of our last video. Or it may be possible that the more efficient use of OPM involved with a lease might make the difference between you owning a company yourself and having to raise the money from other shareholders to make the real estate investment. In this way, you would benefit from all of the added returns rather than having to share the value you create with other investors. I have one more thought for you that we will discuss in more detail in the next lesson. Corporate flexibility matters, and it can be a great source of shareholder value. Up until now, our comparisons of a real estate leasing solution versus an ownership solution just looked at financial advantages and disadvantages of each. But you should take care not to stop there. After looking to the quantitative issues, then take a look at the qualitative issues. For example, are there corporate covenants that restrict your behavior? Is the lease or loan financing assumable? If the real estate debt financing is not assumable, would you have to incur a prepayment penalty to pay it off? If you're borrowing money to finance your real estate ownership, how long is this loan for? Does your financing lock in a fixed rate, or do you have to take floating rate risk? If you're taking floating rate risk, does that mean you have to enter into a derivative swap agreement? If you were entering into a swap agreement, what would it take to unwind that swap? Can your real estate finance solutions be easily modified over time? You might be surprised to know that these types of qualitative issues can have a material impact on the valuation of your business. Now you know how to evaluate the optimal ways to finance your commercial real estate. You can use the same process to evaluate financing choices you have for other assets, but real estate just tends to stand out because it's both expensive and a long-lived asset. And of course, you could have a great goal of one day not having to care about the optimal ways to finance your real estate. Occasionally, we see companies, mostly private, having created so much in shareholder value that they simply would not know what to do with the extra loan or lease proceeds. But that is not the vast majority of us. How you finance your real estate really matters, and your ability to pull that lever of capital efficiency stands to make you richer. Until the next lesson, I'm Chris Volk, and I thank you for joining me on this value creation journey.